Hello and welcome to the Mortgage Strategy Podcast. I'm Kimberly Dondo, and in today's episode, I'm joined by Rob Barnard, Intermediary Relationship Director at Pepper Money, and this podcast is in association with Pepper Money. So thank you for joining me today, Rob.
Kim, thanks for finding time in your packed schedule to fit me in.
Honestly, it's been quite a packed schedule, but I'm glad that we were able to make this happen on quite a glorious day, honestly.
It's beautiful in the capital.
Yeah. So getting more into knowing a bit more about you, could you let us know about your background and how you got started in the industry?
How long have you got?
As long as you need.
All I've ever done is mortgages,
yeah.
to be honest. I live up in the northwest of England in a place called Macclesfield.
Mm-hmm.
And when you leave school in Macclesfield, if you didn't want to go on to university, you had two choices. You either went to work for ICI, AstraZeneca, which has become obviously world famous, or you went to work for the Cheshire Building Society, and that's where I sort of started off in financial services. I worked my way up from a junior filing clerk to an area manager looking after a group of network branches up in the Lancashire region. There for about 12 years, and then I found specialist mortgages, and I joined a company called Verso, now part of Platform, much further down the line. And that's really when I got properly into intermediary specialist mortgages, and that's really where I've made my career since. I've worked at a host of different specialist lenders. We set up a lender called Freedom Lending, which became Wave. People may remember that before the credit crunch, and sadly we built it up so quick and then we had to close it down every bit as quick following the credit crunch, but we weren't on our own. So from there I was part of the team that launched Aldermore Residential Mortgages, and then in 2016 I joined Pepper for the first time, and we brought Pepper to the UK mortgage market. Stayed for 3 years, and I thought the grass was greener elsewhere, so I went, and it didn't work out tremendously well. And they asked me back, so I must have done something right. So I've been back at Pepper now for a couple of years, and I look after the major intermediary relationships, working with all the clubs and the networks to sort of distribute the Pepper products across the UK mortgage market.
Wow, that is such an interesting story, and I always love to know about people's backgrounds, but I also wanted to know a bit more about what is the key message that Pepper Money wants to deliver to the mortgage strategy audience about the current state of the market.
Yeah, I think the specialist market is an area of the market that is undoubtedly growing. At Pepper each year we issue what we call now our specialist lending study that goes into detail about all the reasons why people might look to a specialist lender like Pepper. One part of the sector that I'd like to talk to you about today really is the second charge market. Pepper is the largest second charge lender in the UK at the moment, but I still have this feeling that it's one of the best kept secrets in the market as well. There are so many brokers that maybe don't fully engage into the second charge market, and they could be missing out on opportunities to help more of their customers with their challenging needs. Yeah.
So talking about second charge mortgages, for those who may not know me, what are second charge mortgages?
You're not on your own, because a recent survey suggests that as much as 67% of the UK's population don't know what a second charge mortgage is.
I don't feel so bad.
Don't feel bad about that. Second charges. Well, let's have a look at the name second charges. Yes, we call them second charges, but they could be called secured loans. They could be called homeowner loans. And it's a way that customers can release equity that they've built up in their properties over a number of years to help them with their financial planning, to either pay off further debt, to fund home improvements, or to cover a whole range of different aspects that second charge lending could be perfect for.
Okay. And what do brokers need to know about second charge mortgages? I'm sure there's probably a lot of things that they're unaware of, like you've just said.
Yeah, I think the first thing is don't be afraid of a second charge mortgage, because it is as simple to place a second charge mortgage today as it is to place a first charge. And I think that is part of the problem. People don't use them very often, and so they naturally think they're difficult, they're hard, they're clunky, and they try and look for alternatives. I think it's the same as anything. The more that you do of a particular product, the typical thing, the easier it gets. So I think the first thing is don't be afraid of them. If you're not happy sort of placing the second charge directly with a master broker, a packager yourself, because that's how our distribution works. We work with master brokers and packagers around the country that brokers send their business through back to ourselves. If you're not comfortable with giving the advice on it, and we'll come back to the advice piece in a moment, there are many of our partners here that would take the lead from you for a commercial agreement, and they would give the advice and place the case for you. So the first thing to think about is it's very simple to sort of place a second charge piece of business today, more so than it's ever been. There are so many reasons as well that the second charge market is growing. So if I look at how much business is written in the second charge market, looking at May's figures through the Finance and Leasing Association, which is the most current data that we actually have, on the previous May, so in the 12 months, the market's up 22%. Wow. Which is brilliant. £142 million were completed in May of this year. So I think that's great. Another brilliant thing for the sector is there are new entrants coming to the market. We've got at least 2, if not 3, major players entering the market, or if they've not already done so, very, very shortly. And why do I think that's good? Because I think that drives competition. I mean, what we've done at Pepper over the last sort of 6 months, we've made so many changes to our process, to our criteria, that helps the process become smoother still. Yeah. So effectively what we could find now is if you get a fully packaged case into ourselves, we could be paying that out within a sort of sooner time frame as 5 working days. So it's quick, which is great. So the things that we've done at Pepper that I think help that is we now pay out before consent. We don't have to wait for consent from the first charge lender to us do to sort of lend the second charge. So that's helped significantly. We've looked at the self-employed criteria and we've made major changes in that to help self-employed get a loan away so much quicker and easier than it was before. Yeah. We've tried to make it as paperless a process as we can as well. So what we've done over the last sort of few months is we've taken the need for a wet signature on an application form away. Now really the first time a customer would need to sign something is when the offer actually comes out. And the latest thing we've done is we've looked at income and how much we can sort of use in our affordability calculator. So we've taken a lot more sort of proactive approach with regard to bonuses, overtime, commission, and even now looking to lend to sort of foster carers, which is an area of the market that a lot of people sort of shy away from. We think it's a vital part of what we want to do. So we've made the application process simpler and we've made our affordability process simpler by taking more forms of income coming into it.
Yeah.
And there's so many reasons why you might look at a second charge. So what might they be? Let's bust a myth. Do not think about adverse credit being the be-all and end-all with regard to a second charge. I'll come back to it because it's still a big part of the second charge sector, but by no means is it the biggest.
Yeah.
Probably the biggest sector, the biggest reason that we would lend to somebody in the second charge arena is debt consolidation.
Right.
So people here that maybe have amassed credit card bills, unsecured loans, etc., wrap them all up in a sort of single secured loan to help their finances become more streamlined. Now, I touched on when we opened our conversation a few minutes ago, I talked about how authorised and regulated the sector is, and it absolutely is. The second charge sector is every bit, if not more, regulated than the first charge sector. So advice is right at the heart of everything we do. So I always say second charges might not be for everybody, but I'm a big believer in if they're sold by the right people, to the right people, for the right reason, they can be a really good solution. So debt consolidation, probably about 60% of the UK market is around debt con. About 15% is also about home improvements.
I was going to
mention.
Yeah.
It's a great alternative as well. So why would you maybe look for a second charge to be put in place for home improvements? A lot of people don't want necessarily the new kitchen to be tagged onto the mortgage that might take 25 or 30 years to pay off.
Yeah.
So having a second charge gives them so much flexibility to choose the term that they want to take it over. So you might have a main mortgage that has 25 or 30 years left to run, but you think, you know what, I want to pay my kitchen loan off, if you want to call it that, over a much shorter term. And I think that's really, really important, and that's a really good option for people. I think one of the biggest reasons, take away the debt con, the home improvements and all that sort of stuff, one of the big reasons I think though that people are looking at second charges at the moment is turn the clock back a little bit with me, Kim. Go back to sort of the back end of September 2022, fiscal statement to Parliament.
Yes, we don't like to think about that.
But then the mortgage market reacted in such a way, didn't it?
And rates, very volatile, I think that was the word.
I think volatile's been very kind. The market sort of went into turmoil for a little while, didn't it? But if you think about that, you'd got people at that time that had just taken a 5-year fixed rate mortgage out that might have started with a 1. Of a high 1, it might have been a 1 or a very, very low 2. Now, 2 years later, they want to borrow more money. Is a remortgage necessarily the right option for them? Yes, of course, the advisor would consider that when they give the advice and the approach to it. But a really good alternative there is to leave that skinny 1% rate that's still got 3 years left to go where it is, and look at taking the second charge on a totally separate basis. So you're only paying an increased amount of interest on the second charge borrowing, leaving the first charge borrowing intact, which I think is a really, really good way to look at it.
Yeah.
And I touched on adverse credit, and it really is not the be-all and end-all in the second charge market. And in fact, we probably write a lot more clean without any adverse credit business than we do where there's any adverse history. But again, I touched on briefly about our specialist lending study. Something that we do every year, and we've started issuing it back in 2019, so I think we're about to do our 7th with a couple of iterations some years. One thing to shout out is that we used to call it our adverse credit study.
Okay.
We now realise that adverse credit is only a small part of the specialist sector, so we now call it our specialist lending study, which hopefully gives you an indication as to how the market's changed. But there are some really scary statistics that came out of our last iteration, which was issued in October of last year. And that suggests now that in the UK today, there could be as many as 15.16 million adults that have a history of adverse credit. Now, that doesn't mean a CCJ, a default or missed mortgage payment.
Yeah.
It can literally be a blip on a credit file.
Yeah.
Okay.
We've all...
Of
well,
those...
I don't want to say we've all done it. I've done it.
But it's so easy, isn't
Yeah.
it? You can be laying on the beach and think, crack, I didn't pay my Barclay card or something like that. And
For me, it was a phone bill.
But it's a blip, isn't it?
Yeah.
It's out of the ordinary for you. It's a blip. So you've got over 15 million people that have had that blip or that history of adverse credit. 6.92 million of those have experienced it in the last 3 years.
Okay.
And if you look at how a lender would look at an application for a first charge, so if you're looking at a remortgage, you look at a 3-year credit history. And if you've got some element of adverse credit in your last 3 years, realistically, you're probably not going to pass a credit score of a high street lender. So you'd be forced into a specialist arena where the rates, granted, are a little bit higher. But again, that comes back to my point. Why would you sort of move that 1% rate that you've got 2-3 years left to run on when you can borrow the additional on a second charge? Of those 6.92 million people that have had an adverse credit history in the last 3 years, approaching 1 million of them want finance this year. They want a mortgage this year, whether that be a purchase or a remortgage. So again, if they're looking for a remortgage, surely second charges is a really, really good alternative.
Yeah. And I'm sure you've covered one misconception, but are there any other misconceptions when it comes to second charge mortgages that you come across that brokers might
Yeah, I think people think they're expensive.
Yeah.
So again, it's all relative, isn't it? I think in real terms, if you look at the sort of headline rates in the first charge arena and the second charge arena currently, they've never been closer together. I think one thing that's really, really important is that they're considered. They're considered as an alternative. So again, through our specialist lending study this year, we always used to find that people with adverse credit, you could normally pin it back to what we call a life event, which was a bereavement, a divorce or a redundancy. So picture that credit file. They've paid everything before. They've had a life event, a bereavement, a divorce or redundancy. They've had a problem. They've paid everything since. So you can almost put a ring around 3 months in somebody's credit file. Paid everything before, had a life event, caused a financial constraint, and they've paid everything since.
Yeah.
That no longer, sadly, is the biggest reason that people have adverse credit. The biggest reason that people have adverse credit is because they're having difficulty just simply managing their finances. 36% of people that have adverse credit now say it's just because it's hard to manage in their finances.
Yeah, in the current state.
The cost of living crisis is still biting. Granted, it's eased a little, but people are still finding it very difficult to get from month to month, aren't they? The reason I shout this out is I almost think that mortgage customers in the first charge arena, we should treat them a little bit like you do an investment or a pension customer. Okay. Don't wait for 3 or 6 months until a product transfer opportunity comes up. Keep in touch with them regularly. Even if it's sort of cobbling together a newsletter that you can send out every 6 months or 12 months. And the reason I say that is if you're in constant touch with your customers every 6 months or 12 months, then if somebody is starting to have difficulty managing their finances, you can reach out to them. And maybe a second charge at that stage before they get into financial difficulty could be a really good solution for them.
And when would a second charge mortgage be relevant for brokers to approach their clients with? I know you said that they should keep in touch with them, but when should they think like, oh, this is the moment, the best for this person.
I think anytime the opportunity arises, I think remortgages are the perfect opportunity, aren't they? So if somebody comes in and wants to borrow some further funds, then really second charge, I think, should be the best kept secret that they've got. It's the best tool they've got in the kit bag. Because if you compare, if it was a remortgage, and again, you're moving them from a rate that starts with a 1 to maybe a rate begins with a 4 or 5, depending on their credit history, could even be slightly higher on the whole amount of the borrowing. Whereas if you can leave that existing mortgage intact and just borrow the additional funds on a second charge, I think that's something that's really useful. So a remortgage could have come around, couldn't it, for debt consolidation? It could come for home improvements, as we've said. And again, second charge sort of affordability might be slightly different. There may be sort of affordability might be looked at slightly differently in a second charge arena that might be slightly more advantageous than in the first charge arena as well. So loads of opportunity.
Yeah. And I guess that's why that staying in contact with your client piece is very important for brokers, because they won't be aware of what might be happening in their clients' lives if they aren't keeping in touch. So just
touch base, and I think it just keeps you up to date. And if you can keep one step ahead, it certainly helps people keep on the straight and narrow.
Yeah. So I've really enjoyed this conversation, and I've learned a lot about second charge mortgages that I didn't know before. But now I can, in the future, potentially impress my broker.
and I'm not an expert by any means. All I'm trying to do is bring products that Pepper offer into the first charge arena. Even if somebody listens to this and then a couple of months down the line thinks, what did he say?
Yeah, let's
just go back and have a listen. And I think that's really important. Just consider second charges as a really good, viable option, because used, as I said, by the right people, to the right people for the right reason, it can be a perfect solution.
Right. And finally, while we're wrapping up, I just wanted to know if there's anything else you wanted to shout out. I do know that you have your own podcast that you do, so this is your time to give it a shout out.
Yeah, I do. Specialist mortgages are all I've ever done, and I think it's something I do feel passionate about. And the specialist arena covers a vast area, doesn't it, of topics. So yes, I do have my own podcast available on Spotify and all good platforms called The Specialist.
The Specialist.
And one thing I'd sort of urge people that maybe want to find out a little bit more about second charges, I actually recorded an episode with Matt Tristram from the Loans Warehouse, and that was a really, really good in-depth conversation about the topics I've touched on, but going into it in a little bit more detail. There are so many resources out there for brokers that want to find out more about second charges that I implore them to sort of grab and grasp and have a listen to. You can find that through lenders' websites, through lenders' BDMs, through the master broker and packager BDMs and websites. Don't be afraid of them. Second charges, it's a growing market and could maybe just be that perfect solution for that next customer that gives you a challenging circumstance to solve.
Fantastic. Well, I really enjoyed this conversation, Rob, and I'm hoping that maybe at some point we can pick up and talk more.
It would be lovely. Thanks for finding time to see me.
Thank you.